This is Brad Berry, Chief Investment Officer and Portfolio Manager with Dynamic Wealth Group. Welcome to this market and economic update. In this video, we'll discuss the market rally driven by the so-called Magnificent Seven and the impact on the stock market valuations. This is an important topic because the stock market continues to reach new all-time highs. Some investors may be nervous as they wait for the market to pull back. Others, on the other hand, might feel they're missing out, oftentimes referred to as FOMO, or fear of missing out. In the next few minutes, we'll show that regardless of how you feel in this market environment, the time-tested principles of staying diversified and focusing on the long run are still the best ways to achieve long-term financial goals, or as I like to say, preparation over prediction. First, let's define what the so-called Magnificent Seven even is exactly. It's a group of 7 fast-growing technology stocks, including some of the largest stocks in the S&P 500. Meta, also known as Facebook, Amazon, Apple, Alphabet, also known as Google, NVIDIA, Microsoft, and Tesla. This chart shows the performance over the past few years. You can see that these stocks have performed very well over the past year, contributing significantly to the broader stock market indexes like the NASDAQ. However, it's important to keep in mind that these stocks also are quite volatile, losing nearly half of their value in 2022. Thus, it's important not to focus too heavily on just the past year. As the disclaimer goes that we have all seen many times says, past performance is no guarantee of future results. Second, the market rally has pushed valuation levels much higher. Valuations are very important for long-term investors since they tell you not just what prices you're paying, but what you're getting for your money. After all, when you invest in a stock, you're buying a piece of a company. The hope is that the value of that ownership in the company rises over time. You can see from this chart that valuation levels have increased significantly over the past year. This includes not only the highly recognized PE ratio or price to earnings ratio, but also the price to sales, the dividend yield, and others. It's important to understand that valuations are not a market timing tool. Instead, they are guideposts that help us understand how to allocate to funds in a portfolio. Higher valuations do not mean we should avoid stocks altogether, just that we should be more cautious and diversify across asset classes and sectors. If the economy does continue to grow and corporations increase their profitability, then valuations might improve over time. Namely, the E in the PE ratio could get even stronger, thus bringing down valuations. You see, over time, it's very hard to maintain these high level of valuations. So in a very basic understanding, one of two things can occur to these calculations. Either the price comes down or the earnings, sales, cash flow, etc., grow even faster than the price. Or technically any combination of those above calculations could occur. Beyond valuations, one concern that some investors may have is that a small group of mega cap tech stocks is driving the whole market. While this has been the case to some extent over the past year, historically many stocks have contributed to broad market returns. This chart, for instance, shows the difference between the standard market cap weighted S&P 500 index and an equal weighted index. The distinction may sound technical at first, but can be quite easy to understand. The standard market cap weighted index weights a larger percentage of the index based on the market cap or size of the company. Thus, more is placed in larger stocks, like the Magnificent Seven. So much so that the top 10 holdings currently represent around 30% in the S&P 500 index. An equal weighted index does just that. It puts an equal amount into each stock. So for the S&P 500 equal weighted index, it takes the roughly 500 stocks and puts around 0.2% into each stock. so the top 10 holdings would represent only 2% of the portfolio. This chart shows that over the longer time frames, an equal weighted index has done quite well, even if in the most recent time frame it has underperformed. Thus, we should not overreact to today's technology stock rally. It's important to stay diversified, not just with asset classes, but with different approaches and techniques. At Dynamic Wealth Group, we do not believe there is one answer to the best method of investing. We instead believe in true diversification, with not just asset classes, but with approaches like fundamental analysis, quantitative analysis, and technical analysis should all be utilized. In addition, incorporating alternative asset classes and approaches can all lead to a more truly diversified portfolio. We believe the secret to investing is not in trying to predict the future. I, nor anyone, knows for sure if the Magnificent Seven will continue to outperform. Certainly there can be signs one way or the other, but no one knows what is around the corner. We hope you found these insights valuable. If you would like to discuss any of these topics in more detail, please feel free to reach out. We'd look forward to speaking with you.